The cybersecurity company Fortinet and its stock price is down over 13% in 2025. Is that a buying opportunity for 2026? I'll answer that question in this video, looking at the company's longer-term prospects, looking at revenue growth over the previous several years and returns on invested capital, comparing them against the valuation, and sharing with you my proprietary discounted cash flow model, which calculates a fair value for this stock. I'll do all that in this relatively short video, so let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Over the previous decade, Fortinet's revenue has grown at a compounded annual growth rate at approaching 21%, increasing from $1.3 billion in 2016 all the way up to $6.6 billion over the most recent trailing 12-month period. Fortinet is among the leaders in trailing 12-month revenue among cybersecurity companies, up there with Palo Alto Networks. Of course, the cybersecurity industry is one of my favorite industries when measuring in terms of attractiveness for investors. I see this industry as demonstrating excellent growth above GDP for the next decade or more, as more of our lives become digital. More of our time spent on electronic devices increases the need for cybersecurity. Furthermore, the industry structure is relatively attractive, with competition not impacting profitability extensively, and so each of these cybersecurity companies has an opportunity to generate lucrative profitability, and many of them are already demonstrating lucrative profit margins, Fortinet included. Speaking of profitability, one of the most important profit metrics or unit economics metrics that you can look at is the return on invested capital. This measures how good a company is at taking investor money and investing it in products and services that generate profits and cash flow. This is more comprehensive than looking at a company's profit margins like operating profit margin or net profit margin, or looking at the company's cash flow from operations or free cash flow. The return on invested capital is more comprehensive. It considers how much capital the company has invested. Of course, you can increase your profit margins if you make a big increase in fixed capital expenditure, but it may not offset that large capital expenditure. It doesn't generate enough return on that large capital expense. And so the return on invested capital is more comprehensive. It gives you a more complete look at a company's profitability. Fortinet has done a great job here. Its most recent trailing 12-month period, 21.8% ROIC. That's up from 2.1% in 2017. Now, a good benchmark, a good rule of thumb to use when you're evaluating return on invested capital is to compare it with the company's weighted average cost of capital. Now, you won't be able to find the weighted average cost of capital on many of these platforms. I calculate a weighted average cost of capital as part of my proprietary discounted cash flow valuation model. And for Fortinet, I calculated a weighted average cost of capital of 10.12%. And you can see if we compare that to the company's return on invested capital, which came in at 22%, the company's ROIC to WACC ratio is more than 2 to 1. That's an excellent ratio. A general rule of thumb is if a company has a ROIC above the WACC, it's increasing shareholder wealth. So you just need an over 1 to 1 ratio, and Fortinet has an over 2 to 1 ratio, which is very attractive for investors looking at this company. Now, let's get to valuation. And looking at its forward price to earnings ratio, Fortinet is trading at 29, which is near the cheapest it's been all year here in 2025. In the second half of the year, Fortinet's prospects from the investor perspective have diminished, especially after the company reported earnings in early November. Investors were disappointed in the forecast that Fortinet management provided to investors, even though in the current quarter, in the most recently completed quarter, revenue and earnings per share beat expectations. Investors were not happy about the forecast for upcoming quarter and fiscal year 2025. That's what caused Fortinet stock price to drop most recently, and the growth concerns started in the middle part of this year. So I mentioned I calculated a proprietary discounted cash flow where I shared with you the weighted average cost of capital. This valuation model also calculates a fair value for the stock, which I view as being $95 per share. The current market price is $81.60. So even after applying a margin of safety of 10%, the stock looks undervalued based on my proprietary DCF. And then looking at the market multiples method, looking at the forward price to earnings method, the stock also looks undervalued. So both valuation methods point to the company being undervalued. The cybersecurity industry is an attractive industry for investors. Fortinet is one of the better cybersecurity companies with excellent revenue growth, great profit margin expansion, and a solid return on invested capital, all of which points to a company that I see as being attractive for long-term investors. So I will reiterate, I last updated my buy rating for Fortinet on August 11th. I will reiterate that buy rating today, December 1st, 2025. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.